Well, ladies and gentlemen, I hope you had a nice lunch. And now we're here, and we're going to have Jeremy from Balancer. Please give a round of applause. Woo!
Thank you very much. Hi, everyone. Yeah, I'm Jeremy from Balancer. And today, I'm going to talk about a really important component of DeFi, which is the AMM, Automated Market Maker. This is a technology that really acts as a linchpin for a lot of the activity that happens throughout DeFi. I'm also going to be talking specifically about Balancer, which is an AMM protocol, and give you guys a look under the hood. So I'll start by explaining a bit about the first version of Balancer, Balancer v1. And Balancer v1 is a protocol of liquidity pools. A liquidity pool is essentially a smart contract that acts as a stockpile of tokens. It holds a bunch of tokens, token A and token B, and those tokens are traded against each other. So this liquidity pool basically acts as a place for traders to, if they hold token A and they want token B, they can switch between the two. And on Balancer v1, these liquidity pools can hold up to 8 tokens. This was a big breakthrough in DeFi because we are more accustomed to AMMs that only hold 2 token 50-50 pools. And so you have 8 tokens per pool. And this is a mechanism for creating also not only trading pairs, but also baskets of tokens that can be used sort of like an index fund. So if you take 8 different tokens, for example, a bunch of leading DeFi protocols or layer 1 protocols or metaverse tokens or any sort of sector that you want to kind of create a product that gives you a diversified exposure to, then you can use a Balancer pool to do that. And Balancer v1 really had a lot of success, but Balancer Labs team kind of went back and looked at all of the sort of ways that Balancer v1 was being used and imagined what we think the future of AMMs is going to be. And that's really the philosophy behind building Balancer v2, because while Balancer v1 is an AMM, Balancer v2 is a platform of AMMs. It is a design space for creating AMMs. What does that mean? It means that in DeFi, there are so many different ways that tokens can be traded against each other, and there are so many ways that tokens can be priced against each other. And there's no one formula that will work for everyone. There's no one formula that's going to work in every use case. And so rather than trying to pick one formula that we think everyone is going to want to use, we really wanted to kind of open up for developers to innovate using the primitive of AMMs to create every different type. Let me explain sort of some examples of what I'm talking about. So the most probably well-known AMM that you've probably heard of is Uniswap, amazing technology. And on Uniswap, you can trade sort of 2 tokens against each other. And the way these liquidity pools maintain balance is that when the price of one token goes up, that token is automatically sold by the pool. This is an automated process in exchange for the other token, because it needs to maintain even value 50-50 between the 2 assets that are held in this pool. And now on Balancer, you can create these pools with multiple assets, and the same principle applies where the total value of the pool must be evenly distributed between every asset that it holds. So if I have USDC and ETH and WBTC in a pool together, as the prices of ETH and WBTC move, the pool has to change its balances in order to maintain that equal value. But that is a very different scenario than if you were to create a liquidity pool that contains stablecoins, right? So if you have a liquidity pool that contains DAI, USDC, USDT, for example, these are all tokens that have roughly the same exact value. And so you would use a different formula, without getting too technical, you use a different formula for this type of liquidity pool. And generally, that's called stable swap. So on Balancer V2, one of the types of AMMs that exists is the stable swap AMM. Another type that exists is what's called a boosted pool. And a boosted pool is a liquidity pool that can also allocate the tokens that are inside of the pool into other yield-generating strategies. So what that means is, if I'm a liquidity provider, I'm LPing into a Balancer boosted pool, my tokens are earning, they're earning yield through the trading fees that the pool is generating, right? As every trade that happens on an AMM generates a trading fee, and the LPs usually get most of that. So at the same time, I'm also earning a yield through Aave, because all of my tokens that are in the Balancer boosted pool are also deposited into Aave. And that's a way for me to really maximize my capital efficiency. So if I'm an investor looking for the best yield, I'm really getting best of both worlds there. I don't have to choose between sort of like, okay, am I going to get more in the lending market, or am I going to get more as an LP? I'm actually getting both at the same time. So that's like a different also setup for how like an AMM liquidity pool can work. And one other example is, there are other projects that have built AMMs on top of Balancer V2, such as Element Finance and Sense. And these are projects that have created like a fixed yield type of system where you can actually deposit assets and receive a set yield for a fixed amount of time, sort of more like in traditional finance, but within DeFi. We'll get more into that a little later. So another way to think about Balancer V2 is that it's a protocol for programmable liquidity. What that means is the use case that has been sort of most widely used and understood for the automated market maker in DeFi today is token pair liquidity. Right? Traders, I have this, I'm selling this for that, and I'm using an AMM to make this transaction. There's liquidity available, and I can make this trade immediately. But the thing is, traders are not the only people, or not the only participants in DeFi who actually need access to liquidity. And even more so, what we're seeing today and what we're going to see more and more is that protocols and applications also need to have access to DeFi liquidity. So when you create an AMM that's programmable and flexible, right? So flexible and generalizable, so that it can be used in like many different use cases, then you can serve an audience beyond sort of the day-to-day trader. You can actually you can create this tool for developers, which is what Balancer is. So when you are building an application in DeFi that needs to access liquidity, which many do, this is like a fundamental layer of like how DeFi applications work, then you have a major advantage if you use Balancer, because the liquidity pools in Balancer can be designed basically specifically to the needs of your application. And one example of this is a major game developer that has been working with us. And this game developer has, they have this new game that they've been designing. And in this game, users earn a specific like in-game valuable asset, which is it's a crypto asset, it's a token. And they can also, the more they play this game and the more points that they earn, they can also convert that asset into a more valuable asset, right? So as a player playing the game, you understand what the rules of the game are, and sort of you play the game and you earn certain assets and you try to level up your points. Behind the scenes, sort of underneath, in terms of like what's happening on the smart contract level, is that you have a balancer liquidity pool that contains the different tokens that exist in this game. And as players reach certain levels or achievements, there are actual swap transactions happening on the background on the balancer protocol, which is really awesome. So I mean, we're really just scratching the surface today for what is possible with this technology, but it's super exciting. Yeah, so kind of comparing sort of this new infrastructural model, Balancer V2 versus V1. So in V1, you had a setup where every liquidity pool was its own smart contract. And what that meant was that all of the tokens on Balancer were actually held in separate silos. And when trades were made, including some trades that require like multi-hops, right? So you are trading asset A for B, and sometimes in order for that to happen, you need to actually trade A for C and C for B. That's kind of like what's happening in the background. And if you're jumping from smart contract to smart contract, then you're not really making an efficient use of your gas. So in Balancer V2, we have this single vault architecture. All tokens on Balancer V2 are held in the same smart contract. They're accessed by each liquidity pool depending on the trade that's being made by the trader. So this is not only more efficient for the traders, the protocols, the applications that are accessing liquidity on Balancer, but it's also more ideal for developers who are building with the protocol. This is just another look at this concept. And this is also describing the difference in what an arbitrage process would look like on Balancer V1 versus V2. So one of the very unique things about Balancer V2 is that because all of the tokens are held in one vault, an arbitrager can profit a lot more by finding imbalances between pools, moving tokens from one pool to another, and then receiving the profit actually without having to spend any tokens upfront in order to make that transaction happen. We don't need to go into that detail. So for a developer, from a developer standpoint, if you need access to a liquid market in DeFi, you might consider like building an AMM from scratch, especially if you need one that doesn't work the same way as like a Uniswap or a Balancer or Sushi or Bancor, et cetera. And so you have this choice, like you can build the thing from scratch yourself, or you can bring this formula or the new concepts for your AMM that you want to design, and you can build it on Balancer. And what you actually gain from that decision is that you get the security of Balancer protocol, which is heavily audited, tried and tested, battle tested, built by a really strong team and a very security-minded team. You get the gas optimizations of our single vault architecture. You get access to all of the liquidity on Balancer that's in the vault. And all of the low-level token accounting that you would need to worry about as a developer, you don't have to worry about at all because it's already taken care of by the Balancer protocol. Yeah, and access to DeFi demand through aggregators and the network effects of building on an ecosystem that other developers are also building on. Okay, so who the hell is building on Balancer? Let's go through some examples. We talked a little bit about these fixed rate lending protocols. Element Finance, Tempest, Sense, these are all built on Balancer. Balancer has emerged as the leading platform for this entire space because it provides the flexibility and the infrastructure that a project would need in order to build this type of fixed yield marketplace. Other AMMs do not. And in case you don't know, most of the AMMs that you use, whether it's on Ethereum or any other chain, most of them are basically a fork of the same thing, which is Uniswap v2. And that's a very limited design. It works very well for a certain use case, but beyond that, like you can't build something like this using that infrastructure. So another example, there are also stablecoin protocols that are built on Balancer. And by using Balancer liquidity pools like Fei protocol, which is utilizing a Balancer liquidity pool to essentially manage the protocol, PCV, protocol-controlled value that is held by Fei. And that is part of their mechanism for maintaining the stability of the backing of the Fei token so that when people are making transactions using Fei, they can be sure that the system is liquid and solvent. A really big project, really successful project that's been built on Balancer is called Copper Launch. Copper Launch has really emerged as the most popular platform for token sales, IDOs, initial DEX offerings. New projects that are offering their token to the public and raising money for their project can use Copper Launch as well as Prime Launch. Both are built using Balancer liquidity bootstrapping pools. This is yet another type of liquidity pool on Balancer, which is designed to essentially act as a auction mechanism so that when you are selling a brand new token to the market, it can go through a natural price discovery process and also act as a fair launch mechanism for people to buy into your project. Also mentioned index products earlier. So this is a really big area, I think, that is starting to take off in DeFi. I think there's a lot of interest today in how do you build index fund products for DeFi. Index funds in general, like something that you may have heard of, the S&P 500, it's an easy way for an investor to sort of buy one asset and just kind of have overall exposure to like an overall sector, overall market. You know, when you buy the S&P 500, like the SPY index, then you're basically buying the top 500 stocks in the US stock exchange. And you just kind of, you know, it's a very passive, kind of simple mechanism for investing. Now, in crypto, the same principle, I think, will apply, where you have a lot of people who are coming into the space and wanting to invest, but they might not have the expertise to kind of pick one investment over another. They'd rather you know, buy like a basket of investments if they can. And this new frontier it will largely exist on Balancer because Balancer is the ideal infrastructure. You know, you can build a liquidity pool that on Balancer v2 can contain up to 40 different tokens today, and I think that number will continue to expand as our amazing engineers continue solving these problems. And that liquidity pool acts as this investment product because every liquidity pool is represented by a Balancer pool token, BPT. That BPT is essentially an index asset. And that can be renamed, remarketed, repackaged based on the needs of the index fund. You may have heard of CowSwap, really cool protocol for trading DEX liquidity. And it's actually built on Balancer as well. One of our amazing partners that we've worked very closely with. So every trade that goes through CowSwap is settled through the Balancer v2 protocol. And just talk about two more examples. Aave is one of the biggest DeFi projects you've probably heard of. And they use Balancer in a few ways. The first way is part of their security staking module, right? So there's an 80-20 Aave ETH pool on Balancer, and if you're an Aave staker, you can stake your Aave into this liquidity pool, you can stake your Balancer pool tokens into Aave, and basically that just means that you are providing liquidity to Aave in the public markets while also providing security to the Aave protocol. And they're also utilizing Balancer boosted pools as a source of liquidity. Lastly, I'll just talk about something new. There is a new sort of tokenomic model for the BAL token, VE-BAL, and a couple of projects have emerged so far that are building sort of like these vote bribing platforms for the VE-BAL wars, so to speak. So Redacted Cartel has launched their project very recently called Hidden Hand. Hidden Hand is a platform where if you are a holder of the BAL token and you lock your BAL, what you receive is called VE-BAL, Vote Escrow BAL. VE-BAL is a mechanism that you can use to vote within Balancer governance. One of the things that you can vote for in Balancer governance is which liquidity pools on Balancer receive incentives, like basically extra earnings. They earn BAL tokens through what's called liquidity mining. So there's a lot of competition between the liquidity providers in these various pools to sort of draw that liquidity and draw those incentives to their pool. So they use these platforms like Aura and Hidden Hand to incentivize people to vote for their pools, basically. Yeah, it's just a funny picture. And yeah, I think we're good. Thank you.
Thank you very much, Jeremy. We actually have one question from the audience, which is very directed towards you, which is from a security perspective, is a single vault for all the tokens more risky? And what's the TVL?
Yeah, so that's a great question. I actually had the same question when we were first working on this design, right? Like, if we're going to put all these tokens into one smart contract, does that mean that it's more dangerous? Because a hacker would just need to hack into this one smart contract. And there are many ways that I can answer this question, but I think the most compelling way that I can answer this question is that there's been a bug bounty of 1,000 ETH, which is somewhere around $3.5 million, for anyone who can find any vulnerability in this Balancer V2 vault. That bounty has been up since May of 2021. So it's been almost a year that no one has been able to hack this smart contract and claim that bounty. It's the biggest bounty in DeFi ever. So we're very security-minded. I mean, our team has a very strong security background, and we've done security audits through every major firm multiple times, and all of that information is available to look through in our documentation. So, and that's why we're confident enough to offer $3.5 million in ETH to anyone who can hack the thing, and they haven't.
Super.
And if you can find a vulnerability, please go for it. We'll give you the prize, because that'll just help us make it even more secure.